the bank and the business must record the same entries, because money that we deposit will go in our cash receipts journal. The bank will have to show it on the credit side of our account to show that they owe us that money. Any payments that we do will go in the cash payments journal, and they will record it on the debit side. But there will always be entries at the end of the month when we receive our bank statement that is not the same as the journals, and there's various reasons for that. So I'm just going to discuss these various reasons so that you understand properly what you have to do here. Okay, so if I look at the first thing, I take my cash journals and I tick it off with the bank statement, and then I see there is a deposit which was recorded in our cash receipts journal, but it does not appear on the bank statement. Now there must be a reason why it doesn't appear on the bank statement. Either we made a mistake and it was not supposed to be in our cash receipts journal, or they haven't done this entry. Okay, then we say, let's see, where did this money come from? And then we see it was a direct deposit that was transferred from a customer to our bank account, and this customer has a bank, another bank. So I'm at Nedbank, he's at Absa, for instance. So that means if the money must be transferred from one bank to another bank, it can take up to 24 hours. So the bank will only record it when the money actually appears on the bank statement. And that means we want to say, in the future, the business will have to ensure that the bank records this. So we record a bank reconciliation statement, and we indicate all the entries that the bank still have to record. So a deposit is in our bank on the debit side cash receipts journal, and in their books it will go on the credit side. So I will go and show in the bank reconciliation, as the bank will record the entries and indicate that they have to show that 1317 on the credit side of the next bank statement. Okay, EFT payments that we recorded in the cash payments journal, but they don't appear on the bank statement. The only reason how this can happen is that the bank posts their bank statements to us 2 or 3 days before the end of the month. So we receive the bank statement, and after we receive the bank statement, we still make EFT payments. In the majority of cases, the bank statement is not posted to the businesses anymore. You just go in on the internet and you print it out yourself. So the only reason why there can be an EFT is if I printed out this bank statement, say for instance 4 o'clock in the afternoon, and then 6 o'clock we made an EFT payment. So it means we printed out the bank statement before this EFT payment was done, but the EFT payment is still in the current month. So it's okay if we put it into our cash payments journal, but because they haven't done it, we have to show that they must still record these entries on the debit side in the next statement. Okay, so that's the only possibilities, is that they still have to do a deposit, or they still have to record EFTs. And then there can be the possibility that they made a mistake, and if the bank made a mistake, you will show the mistake in your bank reconciliation statement. If we look at items that appear on the credit side of the bank, and it still doesn't appear in our books. So it means it appears on the credit side of the bank statement. Anything in their books on the credit side will go on the debit side of our books. Therefore, we will record it in the cash receipts journal. So say for instance, this could be the monthly rent deposited directly into the bank account by a tenant. So you will show in your cash receipts journal that we received money from Solly, and it was for rent income because it was not recorded in time. Okay, then the interest earned on a favorable bank balance. So the bank paid money to us, so we will show it in our cash receipts journal, and we will show interest on current account. A payment by a debtor deposit directly into the bank account. So for instance here, T. Brown deposited money, and we will show that the debtor's control account will be credited. A fixed deposit that matured, so we invested money in a fixed deposit and it's the due date, so they paid that money into my bank account, so I will record it in the cash receipts journal. EFT payments into the bank account of the business, so it means customers made EFT payments into our bank account, so we will show that we receive money and we will show debtors control, or if it was for cash sales, we will show it in the sales column. The credit card payments and debit card payments made by customers will always go into your cash receipts journal, because the bank will pay the money over from the bank account of the client to the bank account of the business, so we will record that as cash sales in the cash receipts journal. If we look at the debit side of the bank statement and we look at our cash payments journal, then there can also be certain entries that was not recorded. For instance, bank charges. So all the expenses that I paid to the bank except interest will be added together, and we will show that is the bank charges that we have to pay. If we have to pay interest to the bank because our bank account is overdrawn, it is expense, and we will show that the money will go out of our bank. Stop orders is that I signed at the bank that on my behalf they will pay my insurance for every month, so I will show that that money is taken out of the bank. This amount will stay the same from 1 month to the next month. A debit order is that I signed, for instance, at the city council to pay my electricity. They send the account to the bank and the bank will pay it on behalf of me. Then I will also record it in the cash payments journal. And remember, the difference between the stop order and the debit order is the stop order was signed at the bank. The amount stays the same from 1 month to the next. Debit order was signed at the third party that's going to collect the money, and the amount will change from 1 month to the next month. Okay, debit card payments by clients. So we can make payments out of our bank account, either with we go and we withdraw cash at the bank or the ATM, or you can pay with the EFT, so you transfer money electronically from your account to the account of the people who must receive the money, or you can do a debit card payment where the debit card is linked to the bank account of the business, and the bank will immediately, when you use that debit card, transfer the money from the account of the business to the account of the people receiving the money. So it means when you compare the bank statement with your journals and you see that there's certain entries that was not the same, if it's on the bank statement and it doesn't appear on the journals, then you have to go and record it in the journals. Then you must think, is it money received? It will go in the cash receipts journal. Money paid will go in the cash payments journal. If it's entries that the bank must still do, we will record it on the bank reconciliation statement in the same way that the bank will record it. So it means deposits will go on the credit side of the bank reconciliation statement, and EFT payments will go on the debit side of the bank reconciliation statement.